going to do REX Limited, okay? And this is just like a full corporation tax computation with our add-backs in it, with our other incomes, and with some capital gain tax. I know we haven't done capital gain tax, but just it's only basic capital gain tax anyway. Okay, so REX Limited is an Irish incorporated resident company. The company carries on a retail clothing business from a number of outlets in Ireland. Okay, so it's a corporation tax question, and I'd say the first thing you do when you're asked these questions, go to your requirements and see exactly what you're looking for. So on the second page of that there, calculated REX's limited corporation tax payable for its accounting period 31st of July 2013. Okay, so we're actually doing all we have to do is do the corporation tax computation. Okay, so our first job we're going to have to do is actually work out what our case 1 is. Okay, so we're going to do our little add-backs portion of it, just to get the add-backs back into the head again. Okay, so REX Limited. So this is our adjusted case 1. Okay, if you want, you can actually change the years in there. If you want to make 31st of July 14, so we have like for our own exam, you 31st of July 14. And then if you go over to the next page, just on the part 5 there, change that part 4, the company has a case 5 loss carried forward from the 31st of July 13. And the gain arose in March 14. And the tax written down value figure at the 1st of August 13. And then just what they're actually looking for, 31st of July 14, just to bring it up to date. Because all 14 you'd actually be doing. Okay, so we're going to do our adjusted case 1 first. And the first job we're going to look at our net profit and see what we must actually add back to that. So our net profit is 1721380. Okay, so your starting point is always your net profit. If there was a dividend there, okay, after net profit, and you had net profit after dividend, it's a net profit before the dividend you always take, because dividend is not allowed as an expense. So we've got our turnover, our cost of sales, our overheads, we have a note for our overheads, trading profit, other incomes and gains. Okay, so other incomes and gains, note 2, 417,000. Okay, they're always put back into it first. So you're actually adding that 417,000, taking that off of the 417,000. Okay, because it's other income, you're trying to find what your case 1 is. So that's always deducted inside here first, other income. And that is 417,000.
That's because you put it in separately later on.
Yeah, because we put it separately later on with different headings. Okay, so always do your other income first, and then do your add-backs. Okay, so our add-backs. Our first one is depreciation. So depreciation is always an add-back. Okay, 4267. Okay, so depreciation is always an add-back. our next one is bad debts. We've had notes on bad debts. And when we look at bad debts, it's always the general one we actually look at. We ignore the specific one and it's the general one. So we have an open general reserve of 5,500. Ignore the specific one. A closing general reserve of 7,000. So it's actually gone up by 1,500, isn't it? So we're going to add back that 1,500. So bad debt. General provision. Okay, that's 1,500. Our legal expenses then. So under our legal expenses, we've got pursuing bad debts, we've got disposal of a retail unit, drafting of employee contracts, defending product liability claimed by a customer, and purchase of a new retail unit. So which ones will we add back there? Will be the pursuing bad debts? That's a business expense, isn't it? Disposal of a retail unit is a capital item, isn't it? So we'll actually add that back. Okay, so legal fees, disposal of retail unit. And that is €5,000. Drafting employee contracts. They're right, aren't they? Defending product liability claimed by a customer. Is that related to our business? It is, yeah. And then purchase of a new retail unit. Add it back, because it's capital. That is €9,000. Okay, so anything that's in our budget is always a general provision we're looking at. In our contracts, in our legal ones, it's like a capital item we've had legal expenses for. They're always added back. Then we've got motor expenses. And the motor expenses inside here, what they're actually asking you are the finance leases. Okay, you see the motor car had a finance lease of 6,500, motor running expenses 6,800. The car was acquired on the 1st of June 11 by way of a finance lease and cost 27,000. Okay, so when you're doing a finance lease, you're not allowed to claim that full 6,500. You actually have to add back a portion of it because, okay, I know we haven't got tax reference here now, but I'm going to get on to Richard about that. But the D&E car, so 165 grand per kilometre is a D&E car. So there's actually a formula you actually have to use and we want to add back a portion of the finance leases. Okay, so if you've got a D&E car, okay, so motor expenses and our finance leases. Okay, this is a D&E car. Okay, so the D&E car costs us 27,000. Okay, so we can't claim the wear and or we don't claim wear and tear the full 27. We don't. We claim it on 50% of 24,000, which is 12,000, or half the cost of the car. So it's actually 12,000. We would actually be restricting that down to. So a D&E car is 50% of 24,000, which is 12, or the 50% of the cost of the car, because it's a non-energy efficient car, they're saying. So what we're going to be doing here now in our formula, we'll be taking our finance lease of 6,500 multiplied by the cost of our car minus our restriction, which is 12, all over the cost of our car. Okay? So it's the finance lease multiplied by the cost of the car minus the restricted value all over the cost of the car. So you do the part on the right hand side first, take your 27,000 minus your 12,000 divided by your 27,000. And then multiply that by the 6.5. Which gives you 3,611. Okay, so it's the 27,000 minus the 12,000 divided by 27, which gives you a percentage rate, then multiply that by 6,500, which gives you 3611, and that's our add back. Okay, 3611. So anytime you see a finance lease, you're not allowed to claim the full amount, you have to actually apply a little formula to it. And the second car there, see the finance lease payment was 5,000. Motor running expenses are okay. Emissions of 149 grams per kilometre, and it cost us €30,000. So 145 grand per kilometre car is an ABC car. Okay, so it cost us 30. So what would we claim wear and tear on? 24. Okay, the 24,000. So this time our restricted value is going to be 24. So this time our formula will be, because it's an ABC car, your finance lease of 5,000 multiplied by the cost 30 minus the restricted value of 24 all over the cost of 30,000. Does that ring a bell? Yeah? Okay, so 30,000 minus 24,000 divided by 30,000 and then multiplied by 5,000, 1,000.
It's 5 multiplied by 6.
Did I do that wrong?
No,
No, that's right.
No.
it's 6 divided by 30.
Yeah, €1,000, isn't it? Yeah. I got a different answer to there when I did it.
No, it's 1,000.
6 divided by 30.2, 1 by 5, then it's 1,000.
Oh yes, I didn't. I had 3611 and 1,000. I had 4611 written in, but I just practiced it at home to make sure I know what I'm talking about in the night, you say. I was wondering, is there a why I got 4611? So the total is 4611. I just forgot to write in my 1,000. That's it. Sorry?
It's all the add backs in, is it?
That I think it is. Yeah, we just have the three of them. Yeah, the motor, the depreciation, the bad debts, legal expenses, motor expenses, and we've done our income already. We've actually deducted that off of it. So just add up all them now. So that is 60,378. Just to make sure.
Yeah.
Giving us 1,364,758. Case 1. Yeah? If you look at number 2 then, you see our other income and gains. We're going to have rental income from Irish properties 100,000, rental income from UK properties 210,000, and gain on the sale of retail outlet 107. So our rental income from Irish properties is Schedule D case 5, rental income from UK properties is Schedule D case 3, and then our gain on the sale of the unit is going to be our chargeable gain we're actually going to have to work out. Okay, so just set up a little tax computation now for X. Okay, so Rex Limited. Corporation tax computation. For the 31st of July 14. Case 1. So technically what we've just done is actually a working. Okay, that what we've actually, the add back section we've done is a working. So we can put working 1 in alongside that. We've got Schedule D Case 3, which is our foreign rental income of 210,000. And Schedule D Case 5, which is our Irish rental income. And just leave a little space, sorry, I should have told you, in between the Case 1 and the Case 3. Because we actually work out our capital allowances. So it's good just get your figures in as you go along if you can. If you go on to the next page there, see the company has a Case 5 loss carried forward from the accounting period the year ending 31st of July 13 of €15,000. So Case 5 loss can go against our Case 5 gain of 107,000. So we can actually put in our Case 5 loss in there. So Case 5 loss, brought forward, 15,000. If you wanted, you can show it, the 107 here minus the 15. Just so you're showing you on your actual thing, you've got your whichever way you prefer. Okay? You can actually just show it as a little thing in the side, or you can do it from here and just show your 15. But maybe it's maybe better to show 92. So remember to do 92,000 by the 12.5%. Sorry, 25%. And if we know Case 5 income there, can we do anything with that Case 5 loss? No. It's Case 5 against Case 5. You have to actually carry it forward to the next year again. Yeah.
How many years can you carry forward?
Indefinitely. Yeah. So then the next one, the gain arose from the sale of retail unit. Details are as follows. So we've got our sale consideration for 2014, 480,000. Our purchase price, our legal fees on acquisition, our extension, and our legal fees on sale. Okay, so I have to do a little capital gain tax computation for that. So this is going to be our working 2. Was a retail unit, isn't it? Or retail unit capital gains computation. Okay, so we start with our proceeds figure, which is 480,000. Okay, less our incidental costs. And our incidental costs are our legal fees on the the sale of it, which are 5,000. So let's have incidental costs. And if you see here, we have a purchase price in March 98 of 250. We've our legal fees and acquisition, and we've got an extension in October 2001. So we'll have two little parts to do. We'll have our purchase when we're buying it, plus our legal fees and acquisition, and then we've got an actual extension as well. So that's like enhancement expenditure. Remember from our capital gains enhancement. And just because you haven't got the tax reference material, it's March 1998, so that's 97-98 year, and the rate is 1.232. Okay, so it's 97-98, it's falling between April 97 and April 98,
1.232.
1.232. And then our extension was in October 2001, so that's 2001 year, it's April 01 to December 01, and that's 1.087. Yeah. We've been doing a lot of capital gains tax, George, going back over everything and then adding on new stuff to it. We're just, it's a
I
bit
presume they
of
have a tax reference material for all that kind of
They
stuff.
have to
Oh
do
yeah,
something
you
for
have to
that,
have, they're not expected to remember that, you can't remember that. I was just actually going to email him tomorrow and ask him for a sample of what they, even if we last year's sample to know.
It's probably the same as the ACI.
It has to be the same.
information, though.
Yeah, they're just probably printing them off the, the revenue websites and putting them together. Okay, so we've got our costs. Okay, in March 98, that's 97.98. I just put in the rate there, so we have 1.232, and that is 250,000 plus our incidental costs. And they are 4,000 fees, 4,000 euro for legal fees and acquisition. So it's a total 254,000. So it's the cost you paid for it plus the legal fees you had. So it's 254 by 1.232. So that's 312,928. Okay, and you do them separately. You do the cost price first, and then you do the next one. You do the enhancement one separately. So we've got the extension. And that was in October 2001. So that's 2001 tax year. That's 1.087. And that was 114,000. So it's the 114,000 multiplied by 1.087, which is 123,918. So what do we actually have? So we have a loss, have we?
No, small profit.
Oh, small profit, have we? Oh yeah, small profit. It looked, I thought it was going to be loss first. So 38,154 is our chargeable gain. Okay, and remember you must adjust that. So it's our 38,154 all over, multiplied by 33 by 12.5 equals. $12,726. And just for yourself, you can actually check it by multiplying that by 12.5%, you get 12,591, and multiply this 38,154 by 33%, you should get the same figure. Just if you want to cross check to make sure your figure here was right. So multiply that by 12.5, multiply the 38,154 by 33, and the figure you get should be the same. Okay, to go back over now, that into our charge and gain section. What do we get? 100,726. So I have one more working to do. It's my plant and machinery, and work out my capital allowances on that. Okay, so my third working should go in here. That's my capital allowances. Okay, and I just need to do a little working for that as well. Okay, so they go in here under your 1364758 to give you what your K1 is after capital allowances. So that should be working 3, shouldn't it? Sorry. Okay, so I started off with my tax written down value. Am I given that? I am, my tax written down value figure. So it's my wear and tear schedule. Okay, so I've got my tax written down value at the 1st of August 13 is 312,500. Yes, my tax written down value at the 1st of August is 312,500. So I need my additions, disposals, wear and tear, and then tax written down value at the 31st of July 14. They're the 3 headings you need: additions, disposals, and your wear and tear for that year, giving your tax written down value at 31st of July 14. Okay, the company's plant and machinery was purchased in May 2010 for 500,000. Okay, that's just our cost figure, which we need to work out our wear and tear. During the current accounting period, the company sold plant and machinery with an original cost of 50,000 for 12,000. Okay, so it sold plant and machinery with an original cost of 50 for 12. We're going to do a little balancing allowance or balancing charge on that. And the company also acquired a new plant and machinery at a cost of 147,600, including VAT at 23% during the current period. Okay, so the 147,600 is including VAT. We need it net of VAT. So your 147,600 divided by 1.23, 120,000. So the 120 goes in as our additions. Okay, it's always the price net of VAT goes in as our additions. Then we need a figure for our disposal. Okay, but we haven't got, when you're disposing an item, there's 3 things you need. You need your cost figure, your proceeds figure and your tax written down value figure. So you'll always be given your cost, you're given your proceeds, but you normally have to find your tax written down value figure. So the cost of the item we bought was 50,000. We got 12,000 for it. So we must find out what our tax written down value figure is. So we go back to see when it was bought and see how much wear and tear has actually been claimed in it. So it was bought on all the machine was bought in May 2010. Okay, so our first year for that would be May 10 to July 10. Because see underneath it tells you the company's year end has always had 31st of July and all figures are stated net of VAT and as otherwise stated. So you know going back along, July was always their year end. So the first year they would have claimed wear and tear, and that would be the year ending July 10. We would have July 11, July 12. Sorry. Hello, what the date? #31st of July 13. Okay, sorry, I'm missing a year now. With my computer not doing what it's supposed to do. Okay, so we bought it in May 10. So the first year we'd have claimed wear and tear would be year ending July 10. We'd have claimed it in July 11, July 12 and July 13. We're now at July 14 and you can't claim wear and tear on the last year you actually have it. Okay, because it's not in use on the last day of business, so you can't claim wear and tear on the last day. So we've 1, 2, 3, 4 years worth of wear and tear claimed, isn't it? So 4 years. So that would be 50,000 by 12.5% by 4 years, which is 25,000. So our tax written down value figure will be the 50,000 the cost minus the 25, which is 25,000. Okay, so that's the hard calculation to there. Then you have to think about the getting tax written down value figure. They haven't given a question on this for a while. It's to go back 4, 5, 6 papers. So I'm not sure whether it will continue like that or but we'll just have them gone over again and you know. And I say and the question I gave is something like this off of their papers as well. Okay, so our tax written down value figure is 25,000. So that's the figure that comes out of your, inside your disposal section up here. Okay, because it's like with like 25,000 tax written down value figure out of our tax written down value figure at the 1st of August. So now we calculate the wear and tear. For 2014. So we have machinery cost was 500,000. We have disposal, and here now we're dealing with cost. So it's the cost amount comes out here. So minus 50,000, and we've got an addition. An addition was 120,000, isn't it? So our cost figure now, which we based on wear and tear, is 570,000 by 12.5%. Which is 71,250. Okay, and that goes in above to our grid, 71,250. Okay, which gives us tax written down value figure of 336,250 at the 31st of July 14. Just make sure my adding is right. Yeah, 336,250. Okay, but I'm not finished my wear and tear yet because I have to do a balancing allowance or balancing charge for the machine I sold, isn't it? Okay, so my wear and tear claim per schedule is 71,250. So now I must do my machine disposal. So you take your tax written down value figure, your proceeds. And if you've all those figures kept together, I mean, it's very easy to go and do that. So we have our proceeds figure of 12, tax written down value of 25. So it's actually a loss of 13,000, isn't it? So that's a balancing allowance. You can actually claim 13,000 extra in wear and tear that year. Where if it was a balancing charge, you'd have to take 13,000 off of your 71,250. Okay, so that's 84,250.
You knock that off then with the wear and tear allowance, is it? Or the wear and tear at the top there?
No, you mean up here, is it?
Yeah.
No, that's just for that year on its own. That's just for our schedule. But our actual claim then will be per the schedule plus your balancing allowance. So the 84,250. So I bring that now all the way up to my tax computation again. Which is your case 1. After capital allowances. Okay, so I add up now all my incomes, so it's the up to 1,280,508 plus my 210 plus 92 is 1,582,508. $1,582,508 plus the chargeable gain. We'll be up to 1,683,234. Okay, and apply now my rates. So I'll have 1,280,508. 1,280,508 by 12.5%. Which is 160,064. I have 100,726. By 12.5%, which is 12,591, and then the remainder 210,92, which is 302,000 by 25%. $75,500. Okay, and there's a good idea to actually maybe add up all your figures then to your 100 or 1 million and all them to make sure you're getting the same as above. Hmm. 1683236. Oh no, 4. Yeah, we're right. You get 248,155. And that's our corporation tax liability. $248,155. Yeah? And so like you've got one of them to practice at home as well for homework. It's not as long, there isn't as much in it, but it's got add backs and stuff in it as well. And then there's another one that we're doing as well. Hot tubs is another add back one as well. But instead of having corporation or capital gains tax and like that, they actually look for the closed company surcharge instead. So if you want to change dates on that one as well, which I didn't get a chance today, the hot tubs one. Okay, so it's December 2014. And inside number 1 there, we put that down that he gave Tubbs Limited in March 2000 and what's that? 5 years 12, March 2012. Sorry? Hot tubs, yeah, 1st of March, 1st December 14 instead of 1st December 09. And then the 15th of May 10, change that to the 15th of May 15. And why is the pension important there? You can't have a pension as an accrual, so it has to be an add back. Okay, you can never have a pension accrual at the end of the year, because it mightn't be paid. Do you know what I mean? So you always add back. If there's a pension paid, if there's a pension accrual included inside in your expenses, you have to add it back. So you're calculating corporation tax liability then at the bottom for 2014. And see the top there, just before we go on, looking at the closed company, you see you've got Ben with 40%, Mary with 30%, and Tom 30%. So they're not related, okay, which we thought was the company, but there's 3 of them there, and if you put 2 of them together, they will be controlling more than 50% of the company.
Controlling, isn't it?
Sorry.
Once it's less than 5 controlling,
Yeah.
it's a relation.
Well, it's less than 5, yeah. Yeah, so there's 3 people there.
Yeah.
So if you had Ben and Mary, they can control 70% of it. Mary and Tom could control 60, and Ben and Tom would have 70 together. So they're over, whichever way you go, they're over the 50% cut-off point there for the control of the company for our closed company surcharge. I'll go back over them for the closed companies the next slide. We'll try and get John to give you the codes to get up the. Yeah, he didn't give it to you yet. No, because that was the last time you Mrs. Well, isn't it? Yeah. But if you're stuck, just come to me. But I'll be doing more examples as well. So time away. more. There's only a small question at the bottom here, and I finished it. Alright?
We know what that means.
It's only a very sharp one, it's only for 4 marks.
Do you want me to assume, is it?
Yeah, just the bottom of it there, Silver Limited. Okay, so Silver Limited has the following information for its accounting period ended December 14. Okay, so change that to December 14. We've got case 1, case 5, gains adjusted, a trade charge, we've got paid in royalties, paid in accounting period ended December 14. Calculate Silver Limited's corporation tax for the accounting period December 14, making maximum use of its trade charge. It's very easy to do out that one. Okay, so Silver Limited. Okay, it's a trade charge, not as limited. Okay, so we've got their corporation tax computation. December 14. Okay, so put up our schedules. So Schedule D case 1 is 10,000. Schedule case 5 is 50,000. These are total income. Chargeable gain is 20. Give us our total profits. Okay, so we've got our Schedule D case 1, 10,000, and that's our trading income. We've got a trade charge of 25,000. Okay, so that trade charge, 10,000 can go against our case 1 income straight away. Okay, so our trade charge. Would leave it with 15,000 of a trade charge, and that's going to be used now like a loss memo. It's going to be used on a value basis. We can't use it euro for euro because it's a trade charge. We have to use it like a loss memo. So it's our trade charge of 15,000. So we're going to have a section 396B current year from that. Okay, so you can't take the remaining 15,000 and put it against our 50. You have to do it on a value basis. So our total income there is going to be 50,000, isn't it? Chargeable gain is 20, so our total profits are 70,000. So we'll have 50,000 at 25%, that's our case 5, isn't it? Which is 6,250? No, sorry, 12,500, isn't it? And then we've got 20,000. And we'll see where you're still awake. 20,000 by 12.5% is 2.5. So our total liability there is 15,000. Are we going to have enough loss up here to actually get rid of all that 15,000?
No.
We're not. So what you did in that case, take your 15,000 multiplied by 12.5% and take it off of your 15,000. So our section 396B, current year, value basis will be 15,000 multiplied by 12.5%, which is 1875. So that's our new CT liability. And our full 15,000 is used up. Okay, so your trade charge against your case 1 or case 2 income first, then against your other income on the value basis. Okay, where if that was a non-trade charge, we could have taken off of our total profit straight away, and we could have taken that 25,000 off of this 50 first, which would have saved us a good bit of tax. Okay, so that's just a difference between your trade charge and your non-trade charge. So we finish up with that, and that's a good bit to take in tonight. So my plan now for the next night we're here is to do the group reliefs, and then probably take the hour and a half to start, and then for the second hour and a half go back over a lot of the closed company surcharge and closed company rules again. Okay? And just to bring all these papers I've given out with you.
Next week we're doing.
Next week we're doing Martin, yeah.